All right, guys, the Fed has announced they're keeping rates the same. They are still talking about 2 rate cuts this year, which still blows my mind. I think they're just saying that to appease the crowds. I don't think they have a clue, nor do they want to have a clue. They're going to react to what they see, which is a smart course of action. Now, they did say something that should cause a little bit of concern. But remember, when it comes to investing, we don't care where rates are. That's the bottom line. Anybody who cares where rates are at any given time is not an investor. It's speculation. What we care about is buying great companies at great prices. If you need low interest rates to make good investments, you are not an investor. I want you on this channel because you're an investor and you're here to learn and to realize all this other stuff out there is all BS. Now, the thing of concern is this. The Fed said they're seeing low growth and higher inflation. That is code for stagflation. That's what we had in the 70s. Now, before you go out there and sell everything off in the world, before you go out there and sit there and cry and scream about what's going on and, oh my God, my stocks are going to zero, just remember, the best opportunity in the last 40 years for buying stocks was in the middle of stagflation, in the middle of high interest rates. 1982 was the lowest valuation metrics we ever got to in history. The stock market GDP was at 0.32. How does that compare to today? We're currently at 2.0, 6 times higher. It'd be the equivalent of having the S&P today at around 950. Can you imagine if you had the S&P at 950, how much money you'd make in the next 10 years? Well, it's exactly what happened in 1980, 1982. Stagflation does suck. It's lower growth with higher inflation. And there's still a lot of allegations out there that Trump is purposely trying to throw this economy off its rails so that the Fed is forced to cut rates. But remember, for Fed to cut rates, it means that the economy would be off the rails, and we don't want that. Now, what's happened since this? Market's going up. I don't know why markets are going up. I don't think at the highs of the day, but they're climbing up and climbing up. Now, the market's been rocky this year, and a lot of people are blaming it on tariffs because people are worried that tariffs will lead to inflation, which will lead to a bunch of other things, higher rates, etc. Absolutely. I understand that concern completely. It is fully justifiable to have that concern. But when it comes to investing, every single day, every single month, every single quarter, every single year, bad things happen in the economy. Bad things happen in the world. Were we talking about tariffs a year ago? No, we weren't. As we always said, there's always going to be some spark in the room that causes the explosion. That explosion will cause markets to fall. Now, what's going to really cause markets to fall drastically? Valuation. And valuation's still insanely high right now. Now, can we justify higher valuations today than the first 60 years ago? Yeah, probably, because we've changed our economy. Our economy is no longer a manufacturing economy. It's more of a service-oriented economy with higher rates of growth, higher returns on capital, and more globalization. So I can understand why valuations should be higher. Guys, I really, really want on this channel to focus on the long run. I want you to realize that even the youngest people in this community, our community has a 17-year-old in there, actually maybe a 15-year-old, even in their lifetime, how many things have happened? We had an assassination attempt last year. We've had wars. I don't know if everybody remembered, we had a worldwide pandemic where the world was shut down. Do you remember driving through the streets of your city? First off, you weren't allowed to, but if you were able to go get necessities or a medical emergency, the streets were empty. And guess what? The market is now 2.5 times higher than it was back then. We recovered. We'll always recover. A global pandemic shutdown, and we recovered. So that's why I'm not worried about this. Now, if you're close to retirement and you have 100% of your money in stocks, yeah, I'd be a little concerned. That's probably not the most prudent thing to do, but I'm not here to tell you what to do. It all depends on how much money you have. If you have $100 million and you spend $1 million a year, you can afford to see your money drop by 90%, and you'll probably be okay. But most people out there do not have $100 million a year. That's why it takes, and most of them are also not near retirement. That's why it takes understanding that your goal is back here. We're here, your goal is over here. And every past bear market and crash looks like an opportunity, as according to Morgan Housel, and every future one looks like a risk. They're all opportunities. I hope that markets crash. I hope that the Fed raise rates. You know why I also hope the Fed raise rates? You're a good investor. You're here trying to learn about investing. Good investors do well when it's harder for everybody else. Only idiots can only make money during good markets. If you can't find opportunities, that doesn't mean if the market fell 50%, you should be up. No, but you should identify it as, I love these stocks at this X price, I should love it at 50% of X. And that's the way to look at it. And we don't know what's going to happen up, down, left, right, as they say in Wolf of Wall Street, in the short run. But in the long run, stocks are a weighing machine. So let's continue on to see what else Fed Chairman Powell has said about interest rates. Now, guys, Fed Chairman Powell did say something. Even though our growth is slower, it's still solid, is what he said. They are still worried about stubbornly high inflation, core inflation. Their goal was 2%. It is not there right now. So here is the CME watch group. The next rate decision is May 7th. 81.8% chance, as of today, that rates stay the same, an 18% chance that it drops a quarter point, and a 2.2% chance that it falls 0.5%. Now, is 0.2 a lot? No, it's not. But let me tell you what 0.2 is. 0.2 is 99.8% chance of rates being other than this. In Jim Harbaugh's first year at Michigan, he played Michigan State. Now, I'll never forget this. We had one final kick to make. One punt, game is over. We hadn't beat Michigan State in 4 years, I believe. The ball gets snapped, fumble, fumble, fumble. They try to kick it off. Ball lands in the hand of Michigan State. In fact, a friend of the channel was the Michigan State quarterback, Connor Cook. They grabbed the ball and they ran it into the end zone and won the game. Michigan State won the game. When I looked it up later, the chance of it happening was 99.8% that Michigan would win the game. A 0.2% chance that Michigan would lose to Michigan State. So let's not decline this 0.2% chance, because it literally was 99.8% chance that Michigan would get the punt off and win the game. Go back and watch it. That's that meme where the kid's like this and like in shock in the Michigan crowd. That was very bittersweet, because the other thing is, I have a text to a friend of mine where I was smiling in the text because we'd finally beaten Michigan State again for the first time in 4 years. So these things do happen. So guys, no matter where rates are going, I mean, we can go all the way to December 10th, 2025. Look at this. This is where everybody thinks rates are going to be. Basically, the majority of people, about 61.2%, think that we're going to be between 3.5% and 4% at the end of the year. We don't know. What's interesting is I want everybody to take a screenshot of this. Let's see where this ends up at the end of the year. Guess what? It's going to be crazy. 0.3% chance we're at 2.75 and 3. Guys, can I tell you something? If this is the case, the economy is probably this. What would it take for them to cut rates on a 2.75 or 3%? It would take such a bad economy that they need to just pump money in and get things going. Now, just remember that. This is not what we want. This is not what we want. Now, a lot of people differ on this. I definitely say this. And guess what? If this happened, I'm going to be refinancing every fucking property I own, because that would make me tons of money to be able to refinance a ton of properties. These 3 houses, these big 3 luxury homes I just bought on the lake, my average rate is at 5.375. If rates fell down to this, my rate would probably go down to 4%. And I owe about $6 million on them. So I would save 1.375% on $6 million. That's about, what is that? About 100,000 almost. Maybe 95,000. I would love that. But remember, guys, the economy would be crap. My next question would be, how many weeks a year am I renting on my luxury homes if the rates have to go this low because the economy's crap? Just remember that. Not everything is great and not everything is good. There's a plus and minus to everything. And right now, what I want you to remember is that in your lifetime, awful, awful things are going to happen. In your lifetime, amazing, amazing things will happen. But remember, a great story at the wrong price is a bad investment. A bad story at the right price is a good investment. Not telling you to chase bad stories. But remember, Michael Burry made a lot of money off GameStop before the big run-up. He was buying it at $4 or $5 a share. He sold around 20 to 25, and it kept going. He saw value in a declining business. The story was terrible, but the price was right, and he 5X'd his money. That's what I want people to remember. Guys, at one point this year, I don't know if it's continued on, but we had 16 days in a row in which the market had changed throughout the day by over 1%, and that was a record. And I made a video where I reacted to the markets and to this. The Magnificent Seven, as we said for a long time, are so overvalued, and they drove the market value for so long that they're going to be the big losers in the market going forward. And that has proven to be the case so far. Just like Bitcoin hit a high of 109, got as low as 78, 79. Bitcoin is purely a tech play. That is it. It is not a currency play. It is not an economic play. It is a pure tech play. And the more and more I see people who like Bitcoin and crypto, the kind of people who do, it makes me go, this is going to end poorly. If you love crypto and you're offended by that, sorry. I'm sure you're a nice person. But you need to learn how to invest. Crypto is not investing. So go watch this video where I talk about all these things, including the market being down. Thank you very much for your time.